Howdy, everybody. Welcome to Liberty Call. Today is Monday, September 16th, 2024. Hope you're having a fantastical day out there. It's kind of gloomy here in Colorado today, which we have those days occasionally. So hope you're having a great day and hope you had a good weekend. So we had college football, pro football, baseball. Most of my teams won, so not too bad. So, all right. Well, before we jump into today's numbers and the weekly update, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All right, let's get into the markets for today. Dow Jones was up 0.55%, 228 points, closed at 41,622. S&P 500 managed to make it back into the green, up 0.15%, 8 points, closed at 5634. NASDAQ down 0.51%, 89 points, closed at 17,594. The VIX was up 3.56% today. It's at 1715. Canada was up 0.57, Brazil was up 0.13, and Mexico up 0.03. In Europe, Germany was down 0.38%, the UK up 0.06, France down 0.21, the Netherlands down 0.43, Spain up 0.35, Italy flat at 0, Switzerland down 0.22, and Portugal down 0.7%. Russian exchanges in the green today. MOEX up 2.47%, RTSI up 2.24%. And the Asian markets, the Nikkei was down 0.68%, Australia up 0.27%, New Zealand down 0.56%. In China, the Shanghai was down 0.48%, the Shenzhen Component down 0.88%, China A50 down 0.43%, DJ Shanghai flat at 0%. Hang Seng up 0.31, and the Taiwan weighted has not been open since the 13th. All right, so those are our markets for today. So I think everybody's just waiting for the Fed meeting tomorrow and Wednesday to see what's going to happen with everything there. So we'll see what happens. At this point, I think they're going to lower rates. I saw a headline that said that, I think it was on Zero Hedge earlier, that some prognosticator was saying that he thinks that, he or she could, rates should go down to 3.5%, which would be a 2% drop from where we're at right now. That's pretty significant. Personally, inflation's still, in my opinion, a little warm or too hot at this point. So I would leave things as they are. Personally, I would have continued to raise rates last year when Chairman Powell put the brakes on, but is what it is. All right, let's get into the weekly economic update. Stocks rallied last week as investors received better than expected consumer and producer inflation data. I don't know about the producer data. It was a little on the hot side. The Dow Jones Industrial Average rose 2.6%. The S&P 500 gained 4.02%. NASDAQ was up 5.95%. And overseas markets were up 1.01%. A Wednesday to remember. Stocks bounced out of the gate at the start of the week as risk-on investors made moves before the pending release of the twin inflation reports, the CPI and the PPI. The three major averages added slightly more than 1% on Monday in Monday trading. On Wednesday, stocks initially dipped following the release of the CPI as traders appeared disappointed by the report. By midday, sentiment changed. The S&P 500, down as much as 1.6% in early trading, gained 1.1% by the closing bell. More inflation data out Thursday showed wholesale price increases were tempered. See, that's what the reports I read showed that it came in hotter than expected. So again, one person looks at it one way, another person looks at it another, which helped stocks move higher through the balance of the week. All right, small cap shine. Small cap stocks, as measured by the Russell 2000 Index, have pushed higher in recent weeks, which is a telling move for some Wall Street observers. The Russell 2000 has outperformed the S&P 500 by more than 4% during Q3 so far. One reason is that smaller stocks tend to respond when they anticipate interest rates will trend lower. Investors appear to be positioning themselves in small cap issues, expecting the Fed may adjust rates at its September meeting as it looks to guide the economy to a soft landing. All right, economic data this week. Monday is the Empire State Manufacturing Index. Tuesday, the FOMC meeting, day one, retail sales, industrial production, and Fed official Lori Logan speaks. Wednesday is the FOMC meeting, day two, housing starts and permits, the FOMC announcement, and Fed chair press conference. Thursday is existing home sales and weekly jobless claims. And Friday is Fed official Patrick Harker speaking. Just two companies reporting, or major companies reporting earnings this week. Wednesday is General Mills. Thursday is FedEx. All right, so that's the weekly update. Let's get into the market recap for today. Tech stocks drag, dollar plumbs lows on rate cut expectations. Get my notes up here. All right, on Monday, U.S. tech stocks struggled as the market braced for the Federal Reserve's upcoming policy meeting, where a significant rate cut is expected. There's growing anticipation that the Fed could cut interest rates by as much as 50 basis points to support economic stability amid slowing job growth and moderating inflation. I don't know if the job growth has really slowed. Inflation or unemployment is still really low, and I don't know if I'd say inflation is moderating. It's just not growing as fast. Let's see here. The central bank's decision will be announced on Wednesday, with investors focused on whether the Fed will maintain confidence in a soft landing for the economy or take a more urgent approach to lowering rates. Tech stocks, particularly those sensitive to interest rates, pulled down major indexes. Nvidia, Apple, and Amazon all saw declines, with Nvidia and Apple dropping more than 2%. The broader S&P 500 index wavered between gains and losses, while the Dow Jones Industrial Average reached a new intraday high. The dollar weakened, especially against the Japanese yen, which reached a one-year high. The dollar index dropped 0.29%, reflecting investor expectations of further rate cuts. Treasury yields fell, with the two-year note hitting its lowest level in 2 years, as traders placed a 59% chance of a 50 basis point rate cut. Global markets remained optimistic, with the all-world index rising slightly. Meanwhile, gold prices neared an all-time high, and oil prices surged due to supply disruptions from Hurricane Francine in the Gulf of Mexico. Overall, the market remains focused on the Fed's upcoming decision and its implications for future economic stability. Speaking of oil prices, before I started this, I was listening to Peter Schiff's weekly podcast, and he was talking about how if you were to price oil in ounces of gold, it's actually cheaper than it has been in forever. So, and I know I had talked about this last week, where I was talking about home prices actually if you were to price those in gold or silver, that the home prices are actually fairly stable. It's the dollar that's falling apart or being devalued by the Federal Reserve and our government. So yeah, things are, yes, they're getting more expensive when you buy things in dollars, but in, the rest, if you had all your money and sitting in gold or silver, things would be pretty much as they were. All right. Next up, I got Monday Morning Outlook here from First Trust, Mr. Brian Westbury, Chief Economist. This week's article is titled, "It's Money Not Spending That Causes Inflation." All right. The claim the government spending causes inflation is a misconception, according to the article. While reducing the size of government is beneficial for the economy, government spending alone does not lead to inflation. Inflation is defined as the decline in the purchasing power of money, which happens when central banks create excess money in the economy. In contrast, government spending merely redistributes existing money, taking it from one group and giving it to another, but without increasing the overall money supply. Milton Friedman, a renowned economist, also emphasized that fiscal policy, how much the government spends and taxes, does not directly cause inflation. It only affects who spends and bears the economic burden, not the value of money. Inflation occurs when the central banks inject new money, often through mechanisms like quantitative easing, QE, and the increase in the money supply, which is what drives inflationary pressures, not government borrowing or spending. Let's see. While excessive government spending can lead to higher prices by reducing the supply of goods and services, this is distinct from inflation, which stems from money creation. The article advocates for cutting government spending to boost economic productivity and limit corruption, but stresses that inflation is a monetary phenomenon linked to central bank actions, not the size of government alone. All right, so that's some awesome news there. Let's see, I missed one thing here. Did I do that last one? Let's see. Off the screen. And yeah, I forgot to do that. All right, just a second. Anyways, yep. Forgot to move my notes over to my Word document, so I have no idea what to talk about. Well, I do know what to talk about in this last one, but come on. Here we go. Come on. You know, when you want things to move fast, they never do. When I'm sitting here doing nothing, everything moves super quickly. But when I'm sitting here with y'all sitting here listening to me, well, the 2 or 3 of you who actually watch. Anyways, all right. Last up here, let's get to the last article. And this comes from Zero Hedge. An unprecedented monetary destruction is coming, and this was written by Daniel LaCal. So let's see what Daniel had to say here. All right, here we go. Daniel LaCal highlights the staggering growth of the global money supply and debt, which have surged by 20.6 trillion and 313 trillion, respectively. Developed nations, especially the U.S., France, and Germany, account for over half of this rise. In the U.S. alone, unfunded liabilities reached 72 trillion, nearly 300% of GDP, while other European nations like Spain and France face even worse ratios. Mr. LaCal argues that governments use inflation, a hidden tax, to reduce the real burden of debt. Instead of cutting debt, governments will devalue currencies by printing more money, eroding the purchasing power of citizens, wages, and savings. This process impoverishes the middle class and shifts the burden of debt reduction onto the public without explicitly raising taxes. High taxes, he contends, do not reduce debt, but perpetuate state control over national wealth. Despite the economic damage, politicians offer policies that LaCal deems ineffective, like Kamala Harris's tax deductions for small businesses, which he argues will have little impact as inflation outpaces any potential benefit. LaCal predicts that governments will continue central bank easing, including negative real interest rates and debt monetization, to manage debt, but warns that this will worsen inflation. He concludes that citizens must protect their wealth by investing as governments manipulate currency values to maintain control. The last 2 articles seem to have a theme here that government is not a very responsible steward of our wealth. So it's up to you and me to make sure we're putting our cash in the right places so that we're not eating dirt like the Haitian mud cookies that everybody's been talking about in the news. So anyways, all right. Well, that is everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. Yep, that's where you can go and get all your financial needs, retirement planning, investment planning, whatever you want to do. Give me a buzz. I'd be happy to help. All right. Well, that's everything I had for today. Hope everyone has a fantastic evening, and I'll talk to you again next time. Adios.